Hi, everyone. Welcome to my office hours for week 10, the final week. This is about financial statement analysis, and this is where the course comes together. We spent the first few weeks learning about stakeholders, their decisions, and how they use financial statements to be able to make decisions. Then we spent several weeks investigating the meaning of various specific items on the balance sheet. And in week 10, we are analyzing the financial statements with that understanding of specific items on the balance sheet in order to look for information that allows us to assess a business enterprise's financial performance and financial position. What the creators of the textbook suggest you must know to be able to respond to questions on exams and quizzes. You need to understand how to perform a horizontal analysis on both the income statement and the balance sheet. Likewise, you need to be able to perform a vertical analysis on the balance sheet and the income statement as well. Then we are going to learn how to analyze a statement of cash flows, which is done differently and it's more intuitive than the quantitative and numerical analysis done in a horizontal or vertical fashion. And then finally, there are 4 different categories of financial ratios that are covered in this course, and you should understand when they get used, what types of questions they're responding to, and some particular or example ratios that can be used for each of those different categories. Now, to be able to interpret and analyze a statement of cash flow, it will be most easy if you have a sense of how to interpret information in the financial statements as a clue to what's really going on with the business in terms of financial performance and financial position. And I'll give you a little bit of review information about that in this presentation. In addition to what the textbook suggests you learn, my suggestions for additional insights are don't start conducting an analysis unless you know why you're doing this analysis. So rather than just performing a bunch of calculations aimlessly, it's appropriate to select the analysis type as a tool that's going to help you specifically assess financial performance and financial position. And on slide 7 in this presentation, I will give you some guidance in terms of which type of analysis to select. In addition to horizontal and vertical analysis, I find that combining those 2 types of analysis is very insightful for helping me identify problems and opportunities in a business. This allows us to analyze changes in structure, which comes from the vertical analysis. So, for example, on the income statement, a vertical analysis gives us insights about the structure of how a business entity makes money. And in the balance sheet, the structure helps us understand the composition of assets between short-term and long-term, as well as the composition of financing, primarily between debt and equity. However, I really advise you not to stop at doing the calculations. There's more to be done once the calculations have been completed. And that is to step back and make some observations about the calculated results and see if you can generate some insights about what that means, the underlying phenomena that are going on in the business, the answer to the question, what's really going on here? And where we're trying to get to is to be able to take those insights, which will reveal problems and opportunities, and make decisions or recommendations that will lead to action to help improve the business's performance or position. All right. So throughout the textbook, you've been reminded that stakeholders are using financial statements to make decisions, particularly financial decisions. Therefore, we have to understand, what's really going on with the business. What are the numbers indicating? And try to do this from a business person's perspective, from an owner's perspective, not just from an accounting perspective. What's really happening in the business? Are sales growing? Are we becoming more profitable so that we can generate, hopefully, significant cash flow from operations that we can reinvest and grow the business. And of course, ultimately, we have to get to a decision. This is what the textbook's been harping on throughout the course. Stakeholders need to use financial statements to make a decision. So analyze the statements and make some decisions. And that decision will be best or optimal or most reliant if there are several parts of your analysis that support that decision. And I'll show you how that works with an example we did in class, the in-class demo question from chapter 10, both number 1 and number 2. All right, so to fulfill the requirements for the what you need to know to be able to pass the exam and so on, we'll start with horizontal analysis. And the key thing about horizontal analysis, this is examining each financial statement, the income statement and the balance sheet, from a horizontal perspective, which ideally means we're going across time periods. So you'll see this is a bit like a crossword puzzle, okay? We have some clues for going across and we have some clues for going down. So the vertical analysis will help us going down and the horizontal analysis helps us going across. So when we're looking across time periods, horizontal analysis addresses the business performance criterion of growth. In other words, how are certain things changing over time? And we're particularly interested in some key accounts, most importantly, sales. But also there's other key metrics like operating income. And the changes in operating income depend partly on sales growth. So we can see those revealed through a horizontal analysis. Now, the textbook considers horizontal analysis to be year-over-year percentage changes in a particular financial statement line item. And this is calculated by taking the current year's amount, dividing it by the prior year's amount, subtracting 1, and then multiply by 100 to get a percentage. And you can do that all the way down, all the way down an income statement or a balance sheet. Now, I also recommend that you calculate the differences from one year to the next. You know, if you're looking at last year versus this year, I'm looking to find out by how much did we increase in absolute dollar terms. And the reason this is important is because I'm looking to highlight areas for improvement. And what's going to guide me is focusing on large numbers, especially if I've got a large percentage and a large dollar amount, okay? That's where I'm going to get the best payback for my time analyzing the statements. Now, in vertical analysis, this is like the other part of the set of clues for a crossword puzzle. We're going to examine each financial statement, the income statement and the balance sheet, from a vertical perspective, i.e. looking down in a specific column or time period. So when we do that, vertical analysis helps us understand the structure of either financial performance or financial position. And that structure is represented as a composition or a mix or proportions. And so when we do that, we have to divide, within one statement, we have to divide everything in a particular time period by one particular item. So in the income statement, we divide everything by net sales, and that helps us generate expense ratios and profit margins. On the balance sheet, we divide everything by total assets, and that helps us understand the composition of assets, in other words, the mix between short-term assets and long-term assets. And it also helps us understand the capital structure. So the vertical analysis on the income statement helps us understand the business's financial model, how it makes money, how much of each sales dollar we spend on the various expenses, and how much is left over for profit. And vertical analysis on the balance sheet is most useful for understanding the capital structure, which is the mix of debt and equity financing. And that mix impacts our assessments of both financial risk, which we call solvency, as well as financial leverage. Now, I've indicated that combined analysis is another type of analysis I find very insightful. And so, as the name implies, it combines both vertical and horizontal. You can apply it to both the income statement and the balance sheet. And the way to do it is first do the vertical analysis on each time period, and then look across those vertical analysis calculations, period by period, to observe changes in the structure. For example, has our gross profit margin remained stable or slightly increasing, which is a favorable thing? Or is the gross profit margin declining, which is an unfavorable thing? Same thing about operating profit margins. In an ideal world, I like to see a business with growing sales, stable gross profit margins, and the combination of those two things will lead to an increasing operating profit margin, unless the business enterprise is not paying close attention to managing expenses in accordance with its growth. If we're analyzing the balance sheet, we can look across the balance sheet to see how the percentage of debt and equity is changing. And that will give us insights into, for example, the opportunity about whether or not we might be able to borrow more money from the bank rather than always have the owners putting cash in to pay for the purchase of long-lived assets. So when you've done that kind of horizontal analysis of the vertical analysis, then we can reflect on the importance of these changes in structure, both from the perspective of financial performance when we're looking at the income statement, and financial position when we're looking at the balance sheet, and try to assess whether those structural changes are favorable or unfavorable. That is, are they helping or are they hurting the business entity's financial performance and position? And depending on the preceding step, you're going to need to make a decision about how to improve the situation, that is performance or position, if in fact improvement is indicated as required by your calculations. Now, I mentioned the other thing that I thought was very important when you're going to do financial statement analysis is to understand why you're doing it. Know your purpose. The textbook constantly reminds you that stakeholders use financial statements to make decisions, but Chapter 10 really only illustrates how to make calculations for horizontal and vertical analyses and how to make observations from the calculated results. For example, accounts receivable increased. But that's stating the obvious. And if you really want to derive some value from the analysis, we have to get to the point of being able to make conclusions from the analysis and some insights, which will lead us to making decisions and recommendations that we can then implement by taking action. And then the next time we generate financial statements, hopefully we'll see some degree of improvement. If you don't do this, if you don't get to the point of making observations, insights, and decisions or recommendations, then you're basically wasting your time. Why do the analysis in the first place? Why make all those calculations unless there's some outcome from it? So each of these, every type of analysis should lead us to be able to assess financial position and financial performance in order to help the business survive and succeed. All right. Now, this is a slide that I extracted from the presentation I did in office hours for week 3. And if you remember, we started off in week 3 talking about 3 fundamental goals for every business. The first one was strategic, marketing, mission-oriented. And then goals number 2 and 3 were financial-oriented. Goal number 2 being to survive, which means, carry on from day to day, from week to week, month to month, year to year, staying in business, and hopefully getting to the point of becoming a success. But if you don't first survive, there's no way you can succeed. So what do we mean by succeed? Well, most people think about, making money, which means making profits, growing your profits, and that's driven by growth in sales. So growth and profitability are 2 business performance criteria that most stakeholders evaluate, and they need to go to the statement of income to obtain data to analyze in order to assess growth and profitability. Another aspect of financial performance is having adequate cash flows, and of course we'll go to the statement of cash flow to make an assessment about the business's ability to continue to generate cash flows that will sustain it. So cash flow was kind of the third business performance criteria, and cash balances, which is about having adequate cash to carry on, that's part of our assessment of financial position. And in particular, it's kind of related to liquidity. So liquidity deals with assessing the company's ability to pay, to meet its short-term obligations or liabilities as and when they come due. Solvency is very similar, but it relates to the company's ability to meet its long-term financial obligations as and when they come due. In order to make the assessments of cash balance adequacy, liquidity, and solvency, we will harvest data from the balance sheet or the statement of financial position and analyze it using the techniques that we discussed in chapter 10, such as horizontal analysis, vertical analysis, combined analysis, and ratio analysis. Now, here's an example that we did in class. This example comes from the in-class demo questions 1 and 2. And this is an example of how to apply all three types of analyses, horizontal, vertical, and combined, to the income statement. So in the top left corner of this exhibit, you can see an income statement. And the way I like to do horizontal analysis is I move horizontally across the page, and then I set up some columns to calculate the absolute differences, the absolute dollar change, as well as the relative change expressed in percent. And I've given you the formulas for how to do that on an earlier slide. So once we've done a certain type of analysis, we can then look for large numbers, especially both large dollars and large percentages, to see if we can identify possible problems and opportunities. And in this case, the first item I'd like to draw your attention to is the change in sales is negative. Now, that's shrinkage, that's not growth. And negative sales is a bad omen. So this is the first issue here. I would say this has a relatively small percentage change compared to the other percentages on this chart, but a 5.5% drop in sales is significant. And of course, if you scan the column looking at the magnitude of the dollar amounts, $32,000 is also, for this company, a significant amount. So the fact that sales has declined, it's a negative number. And relatively speaking, this is a large dollar amount. This is a significant problem for this company. Now, it may be caused by something the company's doing, or it may be external to the company, like being in a lockdown during the pandemic. But if we don't fix this, if sales continue to fall, this company will surely eventually go out of business. The other large item on here I notice is the operating expenses. And you can see this is both a large number and a large percentage. And of course, when we try to answer the question, what's really going on here, the phenomenon that sticks out is sales are declining, but this company did not reduce its expenses in response. In fact, it grew its expenses from 104,000 to 138, which is a significant increase by almost a third at a time when sales are falling. So I feel like management, didn't have their eyes on managing the business in this particular case. All right, so what you can see is that because our expenses have gone up so significantly, that's really what's going to be driving the significant declines in profits. Both the operating profit, which fell by 40%, and the net profit, which fell by 44%. Now, to corroborate what we've observed in the horizontal analysis, we want to conduct a vertical analysis, all right? Now, in the vertical analysis, we're basically creating what's called a common size income statement. And the way we create a vertical analysis is we take every item in a particular time period in the income statement, and we divide that item by net sales, all right? So sales divided by sales, in this case, I'm assuming sales are net sales. Sales divided by sales will always give us 100%. And when you're comparing one period to the other, all periods have sales at 100%, and that's what makes it a common size, okay? So when we divide all of the expenses and all of the profits by sales, we get these various percentages. And then once we have done that, we basically can look down one column and get a sense of how the business makes money. So for example, out of every sales dollar, say this is 100 cents, we spend almost 64 cents on the goods that we sell, leaving us 36 cents in gross profit. And in 2021, we spent 25 cents on operating expenses, whereas in 2020, we only spent 18. So that is a huge change. It's a 7.2% increase, and it's the largest percentage point increase of all items on the income statement. Of course, this is pretty significant. Now, while I'm going, I'll compare the period to period in a minute. So after we've spent 25 cents on operating expenses, we've only got 11 cents left out of the gross profit we had available. And then we spend a little bit on interest, a little bit on income tax, and we're only left with 4.7 cents out of $1 of sales. Last year, we had 8 cents. So this, again, is a significant decline. It's almost half, which means, it's really worthwhile to do some analysis to see if we can identify the problems or opportunities to improve the situation, because we clearly can't continue like this. So when we do combined analysis, I don't always make these kinds of calculations, the differences. These are just differences in percentages. So for example, 25% minus 18 gives me 7% increase in the proportion that operating expenses take up out of every sales dollar. But I certainly do, visually compare one thing to another. And the place where most people start is they start looking at the bottom line, called the bottom line, net profit or net income. And we can see that there's a very significant drop from 8% to 4.7%. And of course, the big question is, well, what's causing that? And the net profit is the third level of profit that we look at. The first level of profit is gross profit. And what I've told you in class is that what happens at one level of profit trickles down to the subsequent levels. So if we've got a problem with net profit, the first place I want to look at is what's going on with my gross profit margin. And what we can see here is that this company does not have a problem with its gross profit margin. It's relatively stable. This, with only 2 years, we can't say this is a trend. We can't say that gross profit is continually increasing, but you can basically say it's got an average gross profit of 36.2%. And it's fair, both years are generating more or less the same level of gross profit. But where the wheels fall off the cart is down here at operating profit. We're no longer the same profit margin. We made 18 cents on a sales dollar in 2020, but it fell to 11 cents in 2021. And at this point, there's only one thing that could cause that, and that's the number in between gross profit and operating profit. And we've already accounted for this. We already saw it in our horizontal analysis. This is due to a combination of factors. It's due to sales falling. It's also due to operating expenses increasing simultaneously, which means the operating expenses took a much bigger bite out of every sales dollar. Even though the sales dollar numbers were smaller, they took a bigger bite than they did in the previous year. And this is costing us dearly when it comes down to measuring our profit. So it's this drop, it's this increase in expenses of 7% that basically caused the decrease in operating profit of 7%, okay? And the reason the bottom line didn't decline by the full 7% is because we saved a little bit on income taxes, basically. So that's how we can combine the different types of analyses on the income statement. And just to recap, I move horizontally to create a horizontal analysis where I'm making notes of changes from period to period. I move vertically to do a vertical analysis where I examine the composition or structure of what's going on. And then my combined analysis basically compares changes in structure. Okay, so it's a nice, neat, concise format, well organized, to be able to give you all the data you need. And we can see some consistency here between profit problems and changes in expenses over time. We also know to focus on, like we've got two problems that we should be addressing. One is the decline of sales, but we don't have a problem with, our cost of goods sold and our gross profits. Instead, the other problem is keeping our operating expenses in line with the sales that we're actually generating. All right, so let's have a look. I'm just highlighting here that the difference between these two profit measures, we highlighted in the middle line operating expenses, and we can see here that the year-over-year percentage change was this huge increase of 7.2%. Now let's see how we can apply this to the balance sheet. So on the balance sheet, I'm basically doing the same layout. In the top left corner, I have my financial statement. I move horizontally to the right to prepare a horizontal analysis. And if we go to the next slide, because I couldn't fit it all on one slide, it's like, well, I guess we'll come back to it when I get to the next slide. We'll do the vertical analysis by going down, but I'll show it to you in the subsequent slide. All right, so in the horizontal analysis, we're going to compute these numbers exactly the same way we did for each line on the income statement. We calculate the absolute amount by taking the current year and subtracting the previous year, and that gives us a decline of $16,000. This is our cash balance now, and the reason I'm highlighting this number is because cash is a very important asset to be managed, and we've had a $16,000 decline, which was 40%. So if you cast your eyes down this column and look at the relative size of numbers, 16 is kind of a moderate size number, but the percentage is huge and the asset is important. So that's why I've highlighted this. I always want to be focusing on cash. Now, the next thing I'll draw your attention to, the largest change on year to year was a significant increase in property, plant, and equipment. In fact, it increased $170,000 or 33%. And you have to ask yourself, why were the owners or the managers of this business blowing their brains out, spending so much money on new equipment while sales were falling and also expenses were rising? Now, there might be a very good explanation for this. We don't know because we don't have the facts. It's entirely possible that management's getting ready to grow the business through an expansion program. Maybe they're introducing a new product line. They needed to get new equipment. So that will be something that we'll need to ask management about. But in the meantime, this gets highlighted because of the magnitude of the dollar change and the magnitude of the percentage change. We're looking for large numbers in important items. The next item, of course, is the bank loan. Well, the bank loan was reduced by 23% or $30,000. And the reason I'm highlighting this is because it's a little bit inconsistent with the previous item we noticed. If somebody's buying property, plant, and equipment, it would normally be appropriate for them to be financing some of that purchase, some of those purchases with new debt. And they didn't do that in this case. So that might be an opportunity for us to help this company improve its capital structure if it needs to, which we'll see in the vertical analysis. And then the last large item on the balance sheet here was a huge increase in the owner's capital of $150,000. And of course, that 75% increase helps answer the question, well, how did the business finance the purchase of this new equipment? And what we can see is basically the owner wrote a check and put it into the business. And while that may have paid for the equipment, I don't think it was probably the best use of the owner's capital or the best way to fund the purchase of the assets or to capitalize the business. So let's look now at the vertical analysis. And in this case, there's a slight difference from the way we calculated the vertical percentages in the income statement. In this case, every item in the balance sheet in a particular time period is being divided by total assets. So this we could call a common size balance sheet where every item is expressed as a percentage of total assets. Even the liabilities and equities are expressed by dividing them by total assets. But of course, we know that that's equal to total liabilities and equity. So what can we learn by examining the vertical analysis here? We're trying to understand the structure of the company's financial position. So for example, in the first case, we can see that last year, this company's asset composition was basically 30% short-term assets and 70% long-term assets. This implies the company is kind of capital intensive. It needs an investment in and PP&E in order to generate revenues and profits. But look what happened in the current year. This asset mix changed significantly, where we're now 23% current assets and 77% long-lived assets, right? And of course, you can see over here that this change of 7.3% is like out of one category into another category. All right, so that deals with the asset mix, and we can probably explain why this has happened by corroborating this with our horizontal analysis, where we noticed a huge investment of $170,000 in property, plant, and equipment. So that's what's causing this. When property, plant, and equipment increases, then that's going to shift the percentage composition of assets, both long-term and short-term. In fact, if we go back to the horizontal analysis, you can see that there was a 20,000 decrease in current assets, which was about 8%, right? So it's nowhere near as huge as the long-lived assets changed. And so the long-lived asset purchases is what's really throwing a change into the composition of assets. Now, the other two items I like to look at relate to the capital mix, and that is, with all of the company's assets, with 100% of their assets, how are they being financed? What's the mix of debt and equity financing? So we can look at these two lines, total liabilities and total equities. Last year, we could see that the company's assets were financed 42% debt, 58% equity. This year, it's 33% debt and 67% equity. Now, this change, this shift from debt to equity, makes the company less risky from a financial perspective, but it also is likely to generate a lower return on the owner's capital because they're doing so much financing with owner's equity. And from my experience, I believe it's probably appropriate for this company to refresh its debt and carry more debt and a little bit less equity, and maybe work towards a long-term capital structure of something more like 40-60, 40% debt and 60% equity. We can also see, in addition to the switch in categories here that I described earlier, we can see the same phenomenon happening in the percentage changes in the vertical composition between debt and equity, being a +9% in one and -9% in the other. And I think that these numbers, I don't find these particularly insightful for the balance sheet. You know, I like to just visually scan the changes and see if I can understand the changes in structure. And my main conclusion from the vertical analysis, from the combined analysis, scanning the 2 years, comparing the 2 years, I can explain why the composition of assets has changed because of that large purchase. But I've identified a potential opportunity here in the shift in the capital structure, the shift in the financing mix. I think we could probably get this company to borrow some more money, pledge the new equipment as collateral, and then refresh our cash balances. And if we have surplus cash, we can pay some back out to the owners. Okay. All right. Now, when it comes to analyzing the cash flow statement, we're not using vertical analysis or horizontal or combined analysis. This is something that we do activity by activity or block by block. We start by looking at the operating activities. Ideally, when you look at the operating activities, you want them to be positive. You want them to be large, increasing, and generally greater than net income. And one of the reasons is because net income subtracts depreciation, which is not cash. So cash flow from operating activities should generally be greater than net income. If you can check, all of these conditions, then things should be good in that block. But if one of these conditions is not met, then there may be opportunities here for improvement, in which case you want to connect the observations with your analysis of the income statement and the balance sheet for the interpretation, meaning and consistency related to the cash flows. Okay, so positive from operations, large, increasing, and net income. Why do we want them large? Because we want the operations to be able to sustain the business and contribute significantly towards the purchase of new investments, and also be able to repay any financing that requires servicing. When we analyze the investing activities, ideally, these should be negative. Now, that may sound odd because negative means that there is cash flowing out. But the reason it's expected is because a company needs to continue to invest in its long-lived assets for two reasons. One, to replace, replenish, refresh, and sustain the existing revenues and profits. And two, if it has growth objectives, then it will often be buying new assets to be able to produce more products or provide more services and so on. So that's what we would expect in this case. Also, I should say that investing, cash flow from operating activities is happening regularly, week by week, month by month. And so it has a high frequency. Whereas investing activities, some years you may have no investing activities because the company's not, replacing assets or buying new assets to expand. So there'll be a frequency difference between investing and operating. Now, when it comes to financing activities, whether these are positive or negative really depends on what mode the company's in. It will be positive if the company is raising capital to help finance its investing activities, especially when cash flow from operations is not sufficient to do that by itself. But financing activities cash flows could be negative when the company's in the mode of paying back loans or it's generating enough profits that it can afford to pay dividends. So, as I said, this is kind of an intuitive type of analysis where you need to really understand the nature of what goes on in these three different activities from a business perspective. All right, the last type of analysis we need to look at are ratios. And your textbook identifies four categories of ratios. These are profitability ratios, liquidity ratios, ratios for solvency, and efficiency. Now, the first one, profitability, is calculated from information in the income statement. Liquidity and solvency are calculated from information in the balance sheet. And efficiency ratios are what we call inter-statement ratios, and they're calculated from data in both the income statement and the balance sheet. When we look at profitability ratios, we're trying to answer the question, how much are we keeping out of each sales dollar? And where are we spending our money? So we've already shown you a common size income statement, and basically, except for the 100% number for sales, every other item in a common size income statement already contains a profitability ratio, either a profit margin or an expense ratio. When it comes to measuring liquidity, we're trying to answer the question, can we pay our current liabilities as they come due? And so two ratios that we use for this are to compare the current assets and current liabilities. We generally want to see, the higher the number, the better. If you've got less than one, you're in trouble because that means your assets are insufficient to pay your obligations. But whether it's 1 or 1.5 or 2 or more really depends on the particular industry that you're in. Now, a refinement of the current ratio is called the quick ratio. And this ratio divides what's called quick assets by current liabilities. And quick assets are a subset of current assets. Most commonly, they include cash and accounts receivable. But again, what is included in quick assets can depend on the industry. For example, in a restaurant's inventory is usually quick because they have produce and meat that they need to turn over quickly. And they also have alcoholic beverages, which they turn over relatively quickly because they can get them delivered quickly. So in the restaurant industry, quick assets might include inventory. And that's important because most restaurants don't actually have accounts receivable. When it comes to solvency, we're answering the question, do we have an appropriate capital structure? And so we can calculate something called the debt equity ratio. But what I prefer is the capital mix, which I just showed you in the vertical analysis on the balance sheet, where we look at the percentage that debt is to total assets and the percentage that equity is to total assets. And again, the appropriateness of the mix can depend on the nature of the long-lived assets that are financed and the industry that business is in. Now, lastly, when we talk about efficiency, we're trying to answer the question, are we making productive use of our assets and also the shareholders' invested capital? So to do this, we create interstatement ratios where we take a numerator from the income statement, like sales or net profit or operating profit, and we divide it by something from the balance sheet, which is usually the average of 2 years on the balance sheet. So if we were, for example, going to calculate return on assets, we would take the operating income from the income statement for the current year and divide it by the average of total assets for the 2 years. Other examples of efficiency ratios are accounts receivable turnover and inventory turnover, and you can look those up, how to calculate them in your textbook. All right, so if anybody has any questions, I'll be happy to take those. In the meantime, I'm going to stop sharing my screen. So Julian, I see that you're a regular attendee. Do you have any questions on financial statement analysis?
As of right now, currently, no.
All right. Is there anything else that I can help you with then that's not related to this chapter?
Uh, Sorry, let me just look over here. Uh, I was a little lost with the 4 types of ratios. If like, how are they the same thing as the 4 ways that a business can grow? Because I saw in one of the earlier slides when we were looking at the 5P BPC uh growth areas
Right,
that
business
there's.
performance criteria. The business performance criteria are specific measures of either performance or position, financial position, that key stakeholders want to assess when they decide to deal with the business or not, to engage with the business or not. So those are growth, profitability, cash flow, liquidity, and solvency. There are other business performance criteria like cash management, efficiency, and valuation, but we don't talk about those at all in this course. And some of those are very specific to particular stakeholders, but all stakeholders are interested in growth, profitability, cash flow, liquidity, and solvency. And the 2 main types of stakeholders that we consider are providers of capital. So those are lenders for debt capital, investors for equity capital. And those 2 capital providers, they put a different emphasis on subsets of those 5 primary business performance criteria. So lenders, for example, are mostly interested in liquidity, solvency, and cash balances. Investors are mostly interested in growth, profitability, and cash flow. But still, both sets of stakeholders will look at all 5 of the primary business performance criteria. Now, you can see that the group of ratios that the textbook refers to, profitability was one of those primary business performance criteria. So were liquidity and solvency, right?
Right.
Efficiency is from my set of what's called secondary business performance criteria. So this in itself is also a business performance criteria. And when we put, to give you an example of, I'll do 2 examples. Profitability is a performance criteria, but the way we measure it, we'll go to the income statement and we'll try to measure profit margins at each of 3 levels in a multi-step income statement. So the 3 levels were gross profit, operating profit, and net profit. And the reason we look at all 3 levels is because they give us insights about different aspects of performance. So in the income statement, the gross profit gives us insight about how effectively the company is buying and selling merchandise and how it's managing the cost of the merchandise versus the pricing strategy of the merchandise, right? The gross profit excludes all other expenses. And so we look at gross profit basically to see if the company's gross profit margin is stable or if its profit margins are getting squeezed, right? In some cases, companies manage to increase their gross profit margins, particularly in their early years of development. But stable companies are after maintaining a stable gross profit margin. Now, the second level of profitability is the operating profit margin. And here we're not looking, well, ideally, stability would be the minimum criterion for an operating profit margin. We definitely don't want to see operating profit margin decrease, but operating profit margin has the potential to increase if we can grow our sales volume, keep our gross profit margin stable, and keep our operating expenses under, close management and control our costs, okay? And it's really the principle of something called operating leverage, which you can look up on Google to fully understand that. The principle of operating leverage is what allows the operating profit margin to increase when the company's sales are growing. And I think that operating profit margin is one of the most important metrics in the whole set of financial statements. Everything below the operating profit margin, I don't pay a lot of attention to myself, but that is a key number for me because it really reveals to us whether the business is capable of generating a profit from its chosen business model. And then after operating profits, we have some other expenses that are usually not highly controllable by management, like at least not in the year-by-year basis, like interest expense, sometimes depreciation, income taxes, extraordinary items. So that's why I tend not to pay great attention to that. So profitability is a general criterion that stakeholders want to evaluate. To evaluate profitability, we go deeply into the detail of gross, operating, and net profit. And when we've assessed each of those, then we step back and say, okay, overall, is this company profitable, or does it have the potential to become significantly profitable such that I'm interested in lending money to them or investing money to them so that I can generate a return myself, okay? Now, if we look at something on the balance sheet like liquidity, we're trying to assess whether or not we can stay out of trouble by being able to cash in our current assets in order to pay our current liabilities. So you have to understand what liquidity means. And then liquidity is not the current ratio. Liquidity is a sense of whether or not the business entity can meet its current obligations as and when it comes due. And so we use some ratios, in this case, the current ratio and the quick ratio. We calculate those for each year. We look at the trend in those ratios. We compare them, not just for the same entity over time, but we might compare them to other entities to see if we're, average in the industry or above average or below average. If we're below average, we know there's a way to improve them, and we know to what extent. So the notion of liquidity, we have to answer the question, is this company liquid or not? And we use some of these ratios to give us insights. Like if the company's current ratio last year was 1.3, and this year it's 1.7, and we're forecasting next year it'd be 2.1. That shows an improving situation where we are generating more and more current assets, which has the greater magnitude of the current assets has a more significant level of comfort for us to convert them to cash with a margin of safety to be able to pay our current liabilities. So liquidity is not a single ratio, but we use multiple ratios to try to develop an assessment of liquidity. Does that help explain things?
Yeah, that helps. Thank you.
So I think you were right to pick up on the fact that these categories of ratios are related to the business performance criteria that I mentioned in the first few weeks of the course, right? So the point is, there are a number of ratios that can be calculated for each of these different categories. And the textbook calls them categories of ratios, but I refer to these categories as business performance criteria. Because if after calculating a bunch of ratios, we see a declining trend in the current ratio, we see accounts receivable not being collected, And so the quick ratio is, actually growing, but if we interpret it, it's not a good sign. I might come to the conclusion and say this company is not really liquid. And if I'm a lender, if I say, it's not really liquid, I have a concern about getting my loan repaid. I might not loan this company money at all. So the ratio categories they do align with my business performance criteria. And that's a very good observation that you've made. Any
Sounds
other
good.
questions?
As of right now, no. I might have some in class in the next couple of weeks. I know there's no class this Friday, but yeah.
Yeah, there's one more class left, Julian, and it is the final exam review class. And what I would encourage you to do is there's a final exam review package. You should download that, read it, and perform the problems that are in it. There are, I think, 7 multiple choice questions and a number of calculation problems. So you can expect the questions on the final exam to be very similar to those. So please do them before coming to class so that if you have any challenges, you've identified those challenges in advance and I can help answer your question in class.
I'll make sure to do it. And is that going to be in the same place as the midterm review on the grade site?
I think that the final exam review package is on the main site.
Okay.
Okay. Where you find the the chapters for all the textbook and everything.
Okay.
All right,
Thanks.
Julian, thanks for coming. Have a good night.
Thank you, you too. Thanks for your help.
See you in a week and a half.
See you then. Bye.
Bye.